What's up, good people? Happy Wednesday evening. For those of you on the East Coast, for those of you on the West Coast, or in different parts of the world, it could be afternoon, morning, next day, who knows, but welcome. Thank you for stopping back in. Second live stream of the day. Thought I wanted to end up the day kind of talking a little bit about the Fed and interest rates. For those that follow the Fed, like I do, the Fed had their June meeting, which was June 11 and 12th, where they decided to keep interest rates at its current 5.5% Fed funds rate. But what they do then is after the meeting, several weeks after, they go ahead and release the minutes from those meetings to the public, right? And I had a chance to take a look at that and wanted to walk you guys through where we're at with interest rates and more importantly, how that's going to affect us as investors going forward, right? We got to be real conscious of interest rates and the impact interest rates have on our ability to buy assets and those assets to increase in value to do what? Create passive income for us, get us to our pot of gold at the end of the rainbow. So it's an important conversation that we got to have. Not going to keep you guys long, under an hour. We're going to discuss it and we're going to get on out of here and get ready for July 4th, right? Or for those that celebrate July 4th. Before we get into that, guys, do me a big favor, hit the thumbs up button. Make sure you like this video for me if you don't mind. That way we can try to get this content out to more people so we can touch more people, help more people. So hitting that thumbs up button for me right away before you forget is extremely important, and I certainly appreciate you doing that for me. Also, do me a big favor, go check out my new website, www.richardfain.net. Second link down in the description box. Go check the website out for me if you don't mind. Pick up some of those digital products that were handpicked by me, help you get to your pot of gold at the end of the rainbow. And while you're at the website or in the website, consider joining the private mentorship club that I started about 2.5 months ago, and it's doing real well. We got over 700 good folks in there. We have a good time. We celebrate each other's wins. We certainly give best practices. And we just overall encourage one another to keep the faith, keep investing, keep working your plan. So if you want to be a part of that group of folks, join, sign up, hit that membership button, hit that join button through the website and get yourself over there to that wonderful financial community that we've started, and we're growing. It's growing fast, and we welcome any and all that want to have assistance to help them get to their financial freedom. Last thing, and we're going to dive in, is Moomoo, my self-directed brokerage app. The good folks at Moomoo have a special offer for you. For those of you that want to use a self-directed brokerage app to be able to buy paper assets to build your wealth, get down in the description box and click on that first link. The good folks at Moomoo are going to give you 5 free stocks when you open your new Moomoo brokerage account. Put $100 in there. They're going to give you 5 free stocks of publicly traded companies. So right there already, you got a portfolio without you investing anything, right? 5 free stocks. If you put $1,000 in there, they're going to give you 15 free stocks, which is incredible as well. So get down to the description box, click on the Moomoo link, open up your new Moomoo account today. Go get that free stock, go get that free money, and then send me an email through my website, www.richardfain.net, and let me know you opened the Moomoo account. Let me know you funded it, and I'm going to send you some tutorial videos that the people from Moomoo put together that will walk you through how to use that brokerage app so that you can start buying paper assets to build your wealth. Again, get down in the description box, click on the Moomoo link, and click on the website link, and let's get this party started. Well, all right, guys, let's dive on into this report. Matter of fact, it's a report, but it's the minutes from this meeting this June 11th and 12th meeting that the Federal Reserve, the FOMC committee has. And these are the voting members who actually vote on interest rates, whether we increase interest rates, keep them the same, or decrease interest rates. So it's a very important group of people as it relates to us as investors, because these folks control interest rates. And you guys know, I've always told you, when interest rates go up, assets typically go down, right? When interest rates go down, assets go up, right? So that's why interest rates are so important. Why would they increase interest rates or decrease interest rates? Well, they increase interest rates to do what? Stop inflation, stop prices of our goods and services from going up too fast, increasing in price too fast, right? That's called inflation, right? So they use interest rates to fight inflation. So when inflation starts going up, our goods and services start going up too fast. Why do goods and services go up sharply? Why would they increase sharply? Because over demand, under supply. So when you have a demand for something and you don't have enough supply of it, it drives up prices. The way the Fed stops that is by increasing interest rates. How can increasing interest rates stop prices from going up? Because when you increase interest rates, you cut off access that people and businesses have to cheap money from banks or lenders. You cut it off. Because as rates go up, it's not affordable anymore to borrow money. That's why you see what's happening in the housing market with the 30-year fixed rate mortgage rates. They're so high, it is not affordable anymore for a lot of Americans. So what happens? Those Americans can't buy a house. They have to sit on the sideline and wait till interest rates come down. Same thing with goods and services. Same things, right? If interest rates are too high, somebody that was thinking about getting a new car, they may decide to wait. I don't want to pay no 14% for my interest rate on my new car. I'm gonna wait. See, that does what? It decreases demand. When demand comes down, supply can catch up with demand, prices come down. So that's what interest rates do. They force companies and consumers to think twice about borrowing money to buy stuff, which brings down demand, which then brings down prices. So that's why prices are, it's so important for interest rates to control pricing, is what I'm saying. And what's the mandates? What is the job of the Federal Reserve for some of you guys that really don't know about the Federal Reserve? They got 4 mandates, right? And again, guys, I'm no expert here. I'm just giving you my opinion. You can go look this stuff up too on Google. But the 4 mandates for the Federal Reserve. Number 1 is what? Price stability. They need price stability in our economy. All that means is they want to make sure everybody that lives in America can afford the basic things they need to live. That's price stability. Not just the rich folks. They want everybody living in America to have a fair opportunity to buy the things that they need to live at a fair price, at an affordable price. They call that price stability. That's their number 1 mandate. Their second mandate is to maximize employment, right? Not only do they want people to be able to afford the goods and services, but you got to have a job. You got to have wages in order even to be able to afford the basic stuff. So they want price stability and they want to maximize employment. They don't want too much overemployment, right? They don't need the economy adding 300, 400, 500 jobs a month and then everybody around here with 3 jobs to every 1 candidate. They don't want that. They really want 1 job for 1 candidate. So they want to maximize employment. That's number 2. The third mandate they have is to do what? Regulate and monitor banks, our banking system. That's their third mandate. They got to regulate and monitor banks. Their fourth mandate is our payment system here in the United States. Our payment system. So those are the 4 mandates, right? And the 2 at the top of the list, price stability, maximize employment. All right, now that we got a little bit of background on the Federal Reserve for some of you folks that are brand new, let's dive into some of the cliff notes from this meeting. Why are these meeting minutes so important? Because it tells us what the outlook is for the Federal Reserve and what they're thinking about. Do we got a unanimous group in there? Or do we have FOMC members divided? Do some of them want to increase interest rates? Do some of them want to decrease? Do some of them want to leave them where they're at? These meeting minutes will tell us that. So they release them to the public. And then this could drive assets, stocks, up, down, crypto, up, down, based on what's said in these meeting minutes. So on Friday, when the market opens again, we'll see what the market thinks about what was said in this meeting, out of these meeting minutes. So here's the headline. Fed says it's not ready to cut rates until greater confidence inflation is moving to 2% goal. Now, over the last several months, we've gotten some really good data, right? We've gotten the CPI inflation report for April and May. Good. We've got the PCE report for April and May. Good. We got a good jobs report in April. The jobs report in May was not as good. It showed that more jobs were added than we expected, which is not good for the Federal Reserve when it comes to lowering interest rates. Why? Because they want to maximize employment. They don't want overemployment. They do not want 2 jobs for every person. They don't want 3 jobs for every person available. No, they want 1 job for 1 person, right? Because see, what happens is when you and I know we have the ability to get fired or quit a job and the next day we can find another one, we don't stop spending. We won't stop spending. The only time we're going to stop spending is if we are afraid if I lose that job right there, it's going to take me 6 months to find another one. That's when we stop. But if we feel like, I don't like that job, no way, I'm quitting anyways, I already got one lined up, we're going to keep spending. Because we have no financial fear in us that we're going to suffer any consequences if we spend too much and get fired or get laid off. So they need the labor market to cool off. April, it cooled off, but then it got red hot again in May. So we'll see. I don't know if the jobs report is coming out on Friday. So the jobs report for June is coming out on Friday. So we're going to see. That's a big report. We'll see how many jobs the economy will add. How many jobs did the economy add in June? We will find that out on Friday. Now, ADP already came out with its report, I believe today. It was either yesterday or today. ADP came out with their report, but it's for private companies. The labor or the jobs report encompasses all job openings, all jobs added to the economy, including government. ADP doesn't include government, right? So when that came out, I believe came out today or yesterday, I can't remember. And it actually came in under expectations, but don't let that fool you. It came in under expectations for May, but then the jobs report came out 2 days later and it was above expectations. So just because ADP report comes out, we beat expectations, that doesn't mean the full jobs report will come out the same way. It was flip-flop last month. I'm telling you, ADP came in under the radar, under expectations. The jobs report came in over expectations. So it didn't match up. So just be careful thinking, oh, ADP came in great, we're out of the woods. No, it's not. It was like that last month. I said the same thing until that Friday, the real report came out and it was, way above expectations. So I learned my lesson. ADP gives us a snapshot, but it's not the real report, right? It's not the report that the Fed is going to really dig into. It's going to be the jobs report, right? So let's keep moving. Let's talk about what some of the findings were in these meeting minutes and how that will affect us as investors. How will these interest rates affect all Americans who are investing to build wealth? Federal Reserve officials at their June meeting indicated that inflation is moving in the right direction, but not quickly enough for them to lower interest rates. Minutes released Wednesday showed. Participants affirmed that additional favorable data were required to give them greater confidence that inflation was moving sustainably toward 2%, the meeting summary said. Though the minutes reflected disagreement, see, this is what I was referring to earlier. Some of these folks, they don't have a unanimous agreement on this thing, guys. And really what you want them to be is closer to unanimous. Not 4 of them want to do this, 4 of them want to do that, 7 of them want to do that. We don't want that. We want as close to a unanimous decision as we can. So though the minutes reflected disagreement from the 19 central bankers, these are 19 people on the FOMC committee that they make the decision on rates. Right? So disagreement from the 19 central bankers who took part in the discussion, with some even indicating a penchant towards raising rates if necessary. Now that's a big one. So now you got some folks on that 19 central bankers on the FOMC. Some of them have even went as far as saying they would raise rates under the right circumstances, right? Now, I don't know what those circumstances are. Maybe they'll tell us. So that's a scary feeling, because if they raise rates, yeah, that's not good. We don't want them to raise rates, and I don't think they will, but we don't want them to do that, right? The meeting concluded with the Federal Open Market Committee, that's the FOMC, voters holding rates in place. The Fed targets 2% annual inflation, a level it has been above since early 2021. Officials at the meeting said data has improved lately. Remember, I told you we got the April CPI. We also got the April PCE. And then we came back and we had a really good May CPI, and then just a few days ago, we came out with the May PCE. Now that was after this meeting though, but it still came out really good, right? So we're moving in the right direction is what they're saying, but they're still not satisfied enough to start reducing rates, right? They're still not satisfied. Meeting participants emphasized that they did not expect that it would be appropriate to lower the target range from the Federal Reserve's rate until additional information had emerged to give them greater confidence that inflation was moving sustainably towards the committee's 2% objective. At the meeting, policymakers also provided an update on economic projections and monetary policy over the next several years. This is important information too, guys. The FOMC dot plot showed 1/4 percentage point cut by the end of 2024. We started the year with like 3. Now we're down to 1. Not good, right? Definitely not good for us as investors, because what happens is when you give that kind of guidance, what do investors do? They're like, okay, let's find something else to do. Let's get out of here. They're not getting ready to reduce, so let's not go all in on the stock market. Let's take our money and let's go to treasuries, or let's go back to money markets, and what does that do? That prevents Now, a lot of y'all are saying, well, golly, Richard, I don't think it's preventing anything. The market is going crazy. Well, the market is going crazy for a couple of reasons, right? You got FOMO, that's the fear of missing out, right? You got to understand, you've had like a lot of events happen. The biggest event you had happen was NVIDIA on the entire stock market. That was the biggest event, right? They came out with their first quarter numbers. They killed it. It took the stock market to new heights, right? That's what happened, guys. And then on top of that, you had their 10-to-1 split shortly after they came out with their first quarter numbers. And you had other companies. Now, Chipotle is not a large company by no stretch of the imagination. They got about a $90 billion market cap. But still, you had a 3,000 per share stock that went 50-to-1, right? Now, you got Broadcom coming next week, I believe. They're going 10-to-1. Earlier in the year, you had Walmart go 3-to-1 stock split. So and keep in mind, this is just not about NVIDIA. You had other large, big boy blue chip companies that came out with earnings in the first quarter and first and second quarter that were monsters. You had Meta. Look what Apple's doing right now. You think that's not driving the stock? So what I'm telling you is, despite interest rates being so high, you've had companies that have, even with interest rates so high, they were able to take cash off of their balance sheet, invest that cash, and continue to grow. They didn't have to go out and borrow money. So interest rates didn't come into play for them. Only time interest rates come into play for big boy blue chip companies if they got to go out and borrow money to fund their growth. But when you got billions and billions and billions of dollars just sitting in cash reserve on your balance sheet and you ain't got to borrow no money, you don't care about the interest rates as much. You keep growing. You keep R&D and growing. So you've had that out of the Magnificent Seven. You've had that out of some of the other industries. Not just the tech industry, but some other industries that have been doing good. Look at the banking sector right now. Have you seen what the big four stocks have done over the last 6 months, 8 months? Look at Bank of America. They've almost doubled, not doubled, but they've probably by 30% their stock price is up. I mean, it's in the 40s now. It was hovering at the beginning of the year, what, in the mid-20s, maybe? Look at JP, look at Wells Fargo, look at Citi. So the financial industry is doing very well. Why? Interest rates. Anytime you see interest rates go up in the financial market, not the financial markets, but the financial services sector, that's a good thing, especially if you're a big boy bank, right? Because these big boy banks ain't gonna give you a 5% money market. But guess what? They have trillions and trillions and trillions of dollars on deposit where they're paying people nothing. And they take those trillions and trillions of dollars and guess what they do with them? They put them in their money-making system. They take your deposits, my deposit, put them in the money-making system, and then they get a return on it. They're doing that. That's why you see these stock prices for Wells Fargo, Bank of America, JP going up. That's what they're doing, right? So, although interest rates are high, the tech industry and the financial services industry, they're bucking the trend because they don't really need. I mean, interest rate helps the financial services. Banks love when interest rates are higher. Now, they don't want to have a lot of charge-off debt and loans go bad, but they love when interest rates are high because they can charge more interest and make more, net interest income. Tech company, these tech companies are flush with cash on the balance sheet, man. So they don't have to borrow a lot. Not if they're a well-established tech company. Not if they're a mature tech company. Not if they're a startup, they do. But not if they're a mature one like the Magnificent Seven. Those guys ain't got to go borrow no money. Trust me, they ain't got to go borrow no money. Go look at their balance sheets. You'll see all the cash on their balance sheets. They don't have to borrow money. So interest rates are not going to really affect them that much. Other industries are affected by interest rates more than the tech industry right now. Now, that's my opinion. You guys go out and do your own research. But my opinion is the other 10 or 11 industries are more affected by interest rates because they tend to borrow money more than, say, the tech industry or the financial services industry. That's my opinion. But let's keep going. So the FOMC dot plot showed 1/4 percentage point cut by the end of 2024, down from 3 indicated following the last update in March. So when they had their March meeting, there was a forecast with 3 cuts still on the table. That quickly went down to 1 cut. So you see how things can change, right? Even though the dot plot indicated 1 cut this year, futures markets continue to price in 2, starting in September. So the market is still saying, I know what they're saying, but we're going to still price in like they're going to give us one in September and they'll give us one in November. That's what the market. So AKA back to, why is the market still doing well, Richard, if rates are high? There's where the FOMO's coming from. See, the experts in the market think we're going to still get 2. So that puts what? Optimism back into the stock market. It brings FOMO back into the stock market. That's why you see the things that you're doing coupled with tech. The AI boom is helping. And then I told you financial services companies are doing well too. So all of those things coupled together, optimism, tech market doing great, specifically AI, the semis, the chip makers are doing great, right? You got the Magnificent Seven doing great, right? You have other companies outside of the Magnificent Seven like Walmart and others who have done great too, right? So you see what the Dow is doing. The Dow is just a hair under 40,000 points, guys. I mean, that's all-time high territory. You got the S&P over 5,500 points. Never done that before. And then now today you saw the NASDAQ close at 18,000 over. I mean, it was 18,000 points plus. Just saying, right? What do you think is going to happen though when we start to realize 25 basis point drop in the rates? Month after month after month, we start seeing that rate come down. What do you think is going to happen to assets? I think they go to the moon. That's my opinion. Let's keep moving. Even though the dot plot indicated 1 cut this year, futures markets continue to price in 2. That's what's fueling the stock market too. Those 2 price cut, right? They're pricing in those 2 rate cuts. Also, the committee largely left its economic projections intact, though they lowered their inflation expectations for this year. In discussion over how they would approach monetary policy, the minutes reflect some disagreements. See, this is where things get we got to get more unanimous. Right now, we ain't got unanimous. We're not on unanimous yet. We got to get more unanimous, right? So here we go. So the minutes reflect some disagreements. Some members noted the need to tighten the reins should inflation persist. What do they mean by that? Let's read on. While others made the case that they should be ready to respond should the economy falter or the labor market weaken, right? Several participants observed that where inflation to persist at an elevated level or to increase further, the target range for the federal funds rate might need to be raised. So basically what they're saying here is if inflation continues to be persistent, if it bumps itself up a little bit, it keeps being stubborn, won't come down, maybe we need to raise. Maybe we need to go from 5.5 to 6. That's basically what some members are saying, right? Not all of them, but some of them, right? Some of them. A number of participants remarked that monetary policy should stand ready to respond to unexpected economic weaknesses. There are also people saying, listen, If we keep these rates higher for longer, we got to be real careful that we don't throw our economy into a recession. So we got to be ready to act swiftly if we see the labor market weaken too much, and if we see the economy start slowing down, GDP starts slowing down. We don't see the growth we need in our economy. We may need to step in and lower these rates so we can stimulate the economy, right? So you got people all over the board, right? You got these people all over the board on this committee. That's unsettling for me, but it seems like they're all over the board. The minutes do not identify individual members, nor do they provide exact numbers for the number of officials expressing particular viewpoints. However, in the Fed parlance, a number is considered more than several. Okay. The summary also noted a vast majority saw economic growth gradually cooling. So right now, y'all already know we last year, I think we ended the year with a 3.4 GDP for 2023. And really what the mandate is 2%, right? We want the economy to grow at minimum 2%. Not, we grew way over that last year. This year, we're more closer to the 2%, right? So it says, the summary also noted a vast majority saw economic growth gradually cooling and that the current policy is restrictive, a key term as the officials contemplate how restrictive policy needs to be while bringing down inflation and not causing undue economic harm. And that's one of the things some of the members are concerned with is if we keep rates at 5.5% for too long, we run the risk of hurting the economy, of hurting the labor market. We'll see, right? That's just one way to look at it, right? So since the meeting, officials have largely stuck to a cautious script, stressing data dependency rather than forecasts. However, there have been indications from multiple officials, including Chairman Jerome Powell, that continued encouraging reading of inflation would provide confidence that rates can be lowered, right? So they're going to continue their readings on inflation, and if they believe they got enough data to support it, they'll start reducing. A lot of people believe that'll be in September, right? We'll see tomorrow. We'll see on Friday when we get the jobs report. We already know we got two really good inflation reports for both April and May. So now let's see what the jobs report for June comes out with. And then obviously we'll be backed up with the June CPI inflation report as well. That's important data. I still believe, guys, we'll get a 25 rate cut in September. That's what I believe. I just can't see them not cutting by September, right? That's what I think. So, however, there have been indications from multiple officials, including Chairman Jerome Powell, that continued encouraging readings on inflation would provide confidence that rates can be lowered. In an appearance Tuesday in Portugal, Chair Powell said the risk of cutting too soon and risking a resurgence in inflation against cutting too late and endangering economic growth have come more into balance. Previously, officials had stressed the importance of not backing off the inflation fight too soon. So that's what you got out of the report, guys. It was it's pretty interesting, right? You don't know how many of the 19 members, we don't know of the 19 members really. We don't know how many of them are pushing for an increase. We don't know how many want to keep it where it's at. And we don't know how many actually want to start reducing. But clearly, out of the 19 members of the FOMC, you got members that feel all three of them are justified. That's the part where, as investors, we got to continue to pay attention and watch what's going on because what will happen is you will see the Federal Reserve governors, Federal Reserve presidents. Now, everybody you hear say something in the newspapers or on the news, that doesn't mean they're a part of the 19-member FOMC. Some of these folks are not, but they're still part of the Fed because they're either a Fed president, a Fed governor, different parts of the country. So people still interview them and ask their opinion, but that doesn't mean they're a voting member though. So the 19 voting members, you kind of saw what was in the minutes there. I read to you sort of the cliff notes from the minutes, and you can see the 19 members, they're all over the place. Even saying that though, the market, the stock market, the experts believe we get 2 cuts. And I saw somebody in the private membership club, the private mentorship club said something about 3 cuts. So they must have read a report somewhere where some expert is saying 3 cuts. But the broader experts in the market believe 2 cuts. I don't know about 2 cuts. I certainly believe we'll get 1. I'm not sure about 2. We'll just see how the data comes out. Certainly would welcome 2. Now, I do remember they're saying 4 cuts for next year, 25. So if we can get 2 this year and then look towards 4 next year, I think we're going to be in good shape. That's what I believe, guys. I'm going to continue to do what? I'm going to continue to invest. I'm just going to continue to stay with my plan and just keep dollar cost averaging in and keep buying these companies at a discount. And I know some of y'all are going to be like, Richard, what in the world are you talking about? What discount? And we're trading at all-time highs right now. I still believe, guys, it's a discount. I think we're going higher. I do. I keep buying because I think we're going higher. I do. I don't see 5,500 points for the S&P as a ceiling. I think that's the floor right now. That's the floor. The ceiling is 15,000 points is the ceiling. The floor has been reset to 5,500, guys. This is the new normal now. The market has accepted this. Yes, could we have a correction and it go down 20%? Absolutely, but that's a normal function of the overall stock market. So that doesn't bother me. A 20% correction is a temporary correction. That don't bother me, right? Because I know the market has already accepted 5,500 points. Once the market accepts it and it stays there for a period of time, guys, that becomes the new floor. Does everybody follow me? Same with individual stocks. All right. Tesla right now, I believe, closed at what? 248. 2 weeks ago, it was in the 170s. So you see what I'm saying? This whole stock market thing is set up for companies to go higher, stocks to go higher, ETFs to go higher. The whole thing is set up for that, right? Right? Now, you're going to have interference, though, right? You're going to have interference. I thought this was interesting. This is the interference you have, guys. Check this out. I thought this was interesting. Let me see if I can get this thing back. I just want to read y'all this. Here it is. This is interesting. This is interesting. Elon Musk vows Bill Gates will be obliterated if he doesn't stop shorting Tesla. See, this is what I'm telling y'all, guys. If you're on my live stream this morning, I went through and told y'all everybody isn't for these companies' stock to go up. A lot of these rich people, these really, really wealthy people, these Wall Streeters, these wealthy politicians, these billionaires, a lot of times they vote and they try to go against the stock. And guess what Elon Musk is telling Bill Gates? You guys know who Bill Gates is, right? This is the founder of Microsoft. This is like one of the top 5 richest men in the world. And Elon Musk already told him, I'm going to obliterate you if you don't stop shorting our stock. I keep telling y'all, that's what's happening with NVIDIA right now. I looked it up earlier before I got on this call. I just wanted to look up what were the short positions out there on NVIDIA. And I could have looked it up wrong, guys, but I thought I saw around 25 billion. Now, I could be wrong. I'm not real good at that. But I thought I saw $25 billion in short positions against NVIDIA. And I know it's pronounced NVIDIA, but I call it NVIDIA. Same with Tesla. You got Bill Gates, one of the richest men in the world, shorting Tesla. What does that tell you? Everybody is not betting on the stock to go up. They want it to go down. So what does your boy Elon say? He's going to obliterate you. Elon says, I'm going to obliterate you if you don't stop shorting our stock, Tesla stock, right? So all I'm telling you guys, there are manipulating factors in our stock market right now, especially in the tech space, especially with chip makers, especially with the AI subset of the tech industry. It's a lot of manipulation at a really, 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 really high level that you and I don't have privy to. But that's what's going on. When you got a guy like Bill Gates, who's already the richest man in the world, not the richest, but one of them, why would he be shorting Tesla? He already got $100 billion. Why do you think he's shorting Tesla? He's probably shorting Tesla just to get at Elon Musk. He's probably shorting it just because he can. He probably is shorting it because he don't like some of the things Elon Musk is doing, and he's using his $100 billion to challenge him. I know some of y'all are like, why would he do that? Because they got nothing else better to do with their money. What else he gonna do? The guy has $100 billion. There ain't nothing financially this guy can't do. Nothing. This guy probably don't even, I ain't gonna say that. But my point is this. So when you look at these companies, guys, you gotta understand there are things happening and going on behind closed doors you and I are not privy to. Why would a company like Tesla have one of the richest men in the world shorting their stock? Why would NVIDIA, one of the most expensive companies in the world, one of the most valued companies in the world, why would you have over 25 billion in short positions? And a lot of y'all are wondering, why ain't the stock going up? Why is it yo-yoing? That's why. You have forces, very, very wealthy forces that have a vested interest in that stock coming down, not going up. But they can't do that forever. Like I said this morning, they can't do it forever, right? At some point, these interest rates are going to come down. And at some points, the short positions are not going to, they're going to get, what he means by obliterating Bill Gates is when you make these short positions, you're betting that the stock price won't go up. If the stock price goes too high, you lose. That's what he means by obliterating. What Elon is basically telling him is, continue with your shorting. We're going to keep running this stock price up and you're going to lose it. You're going to get obliterated. And that's what people are trying to do with NVIDIA. They know NVIDIA is going to run at some point. So what they're doing now is manipulating the stock price to make money as long as they can. They can't hold it forever, guys. They won't hold it forever. Just like they couldn't hold Tesla forever. Eventually, Tesla did what? It had one good earnings report and it rocket shipped. That's what happened. They came out with their numbers and the numbers beat the market, and it no longer could the short positions hold them. Now, if you're in a short position on this thing right now, you're probably losing money, depending upon when you put the short play in, right? So all I'm telling you is there are things happening in our stock market that manipulate it at the highest level. Only thing we can do is pick big boy blue chip companies that we believe have the opportunity to create wealth for us. And I told you this morning, and I'll tell you again. Two things you got to think about when you're thinking about these stocks. When you see a stock going down in value, when you see it going down and you're like, goodness gracious, why is this thing going down? You got to ask yourself two questions. First one is it market behavior that's causing the stock to go down, or is it business performance? Those are the two questions you got to answer. Anytime you see that stock going down and you're like, what in the world is going on? Ask yourself that. Go out and research that. That's what you got to go research. Because if it's market behavior, you're good. You're good. The market going to do what it's going to do and the stock will be fine. If it's business performance, that's when it's bad. Because that's telling you something materially has changed with the company. Either they're not profitable anymore, their revenues are going down, they're missing expectations, they changed CEOs. Somewhere along the way, they lost customers. Maybe one of their major products got, you can't sell it in certain parts of the world. I don't know. But if it's business performance causing the stock go down, that's when I bail. That's when I bail on the stock. But if I look at the stock and I say, no, it's not business performance. These guys are still, look at their last quarter. They did great. The quarter before that, they did great. The quarter before that, they did great. Here are the products they got coming out in 25 and 26 that should change the game for them. So they're still innovating. They got products in the queue, right? They're working on more products. See, when you got that going on, that gives me a peace of mind with NVIDIA because that's the position that they're in, even though the stock price is being a yo-yo. And that's all due to market manipulation. That's all that is. Plain and simple, guys. That's strictly market manipulation. It ain't got nothing to do with business performance. It's all market behavior, market manipulation. So for me, I just continue buying NVIDIA because I know it's not the company. And I know at some point we're going to hit a catalyst and no longer can the market manipulation or market behavior stop the stock from exploding. You can at some point. And that might be August 28th, 2024, when their Q2 earnings report comes out. See, once that earning report come out, guys, if you're in a short position and that thing come out good, you're going to get obliterated. So what you're doing right now is prior to that report, guess what's happening? Jokers shorting the stock. They're manipulating the market. They're putting all kind of propaganda out. They're getting sued. People are doing this, people are doing that because they know if they get caught short when that Q2 come out, they're going to get obliterated. I guarantee you, well, I can't guarantee you, but my opinion is this. Prior to the Q2 numbers coming out on August 28th, I'm going to go look at the short positions on this stock. And I guarantee you they won't be as high as they are right now. I can promise you that. That's not a guarantee, but I can promise you they won't be. Because why? They know this company has killed it. And they're going to kill it again on August 28th. They're going to come out with, because I'm telling you, they're selling the black whale right now. They're taking orders on the black whale right now and shipping them. And listen, they're selling this thing right now. And right behind that, they got the Rubin coming. So all I'm telling you is, listen, man, don't abandon your plan. These interest rates are going to take care of themselves. At some point, we're going to start reducing in September. I think we'll see the first reduction in September. Remember, the Fed will be meeting in July. Right? They'll be meeting again. I believe it's the end of July, if I'm not mistaken. I think it's the end of July. They'll be meeting again. Now, they won't reduce in July, but I think in September they will. And then I think perhaps, depending upon how things are going with inflation, they may give us a little Christmas present, a little early Christmas present with a second 25 reduction, basis point reduction. So, and if they do, I think we continue to set new floors. I think you're going to see the S&P maybe hit 6,000 points this year, depending upon what happens with interest rates, what happens with labor market, what happens with GDP. I think you got an opportunity to see the S&P hit 6,000 points this year. Maybe the NASDAQ 23, 24, 25 maybe. I don't know, guys. Maybe Dow 45. We're setting new floors every day. We're setting new floors. So that means ceiling goes up. When we reset the floor, the ceiling goes up. Again, I think the S&P got a 10 to 15,000 point ceiling over the next 6 years, maybe by 2030. It could be 10,000 points by 2030, guys. That's 4,500 points from where it's at right now. Think if you were invested over that next 6 years and you captured that 4,500 points. Think about that. Think about if you're invested in a company like Tesla and over the next 6 years, it runs itself up to $500-600 a share, maybe $1,000 a share. I don't know. Because see, what's going to happen with Tesla is they're going to evolve from just a EV company. They're going to revolve into controlling all the autonomous driving, all the robo-taxis, all that stuff. They're going to lead all of that. I think they are. See, I don't think they're going to stay. Well, number one, they're a tech company that makes EVs, right? We know that. They're a tech company. But I don't think they're just going to be a tech company that makes EVs. They're going to be a tech company that does a lot more than that. If you see what these guys got on the burner and what the vision is, they want to be more than that. Way more. So I'm going to bet on them. I'm going to keep betting on Tesla. I'm going to keep buying Tesla. Yep, it's a yo-yo. And y'all know how I'm going to do the yo-yo. When it goes down under 150 a share, I'm going to buy it. When it goes back up, I'm going to sell it at 250 a share. So on Friday, if it gets to 250, I'm selling it. And I'll wait for the yo-yo back down again to 150, buy it again, hold it again, sell it again at 250 again. That's the yo-yo effect. I can get rich off of that. See, I know what my parameters are, and I just stick to my parameters. It goes under 150, I buy a ton of it, and be patient. When it goes back to 250, at some point it will, because it always does, right? I sell it. Make me $100 a share, and I do that every time it yo-yos. I'm okay with that. I'm okay with that. But that's how I handle fast-growing companies, right? Now, I'm not necessarily going to do that with NVIDIA. I'm going to just stay in NVIDIA and continue buying the dip. Every time it dips down under a certain dollar amount, I'm going to buy more. Because I'm waiting on, see, NVIDIA's explosion is way bigger than Tesla's. Way bigger. When NVIDIA goes, it goes 400-500 points. $400-500 a share. And that's what I'm waiting on, right? And that's going to happen at some point. I still believe it'll be $200 a share by the end of the year. That's just my opinion. I believe that. I believe that. If they come out with those Q2 numbers and they back it up with Q3 numbers, this thing going through the moon, man. So that's what I'm waiting on. I'm going to continue dollar cost averaging in. I'm going to continue investing. I'm going to continue being patient. I'm going to continue watching and keeping up with the Fed so that I understand the clear direction and I can see the light at the end of the tunnel that they show me. I'm going to continue doing that. Right now, the market sees 2 rate cuts, and that's going to continue fueling the stock market, that optimism, right? That optimism that there are 2 rate cuts coming. Now, if at any point they clearly say no rate cuts, obviously that optimism is pulled out of the stock market and it goes down. Because in a normal economy, when rates are this high, the stock market shouldn't be doing what it's doing. But it's doing that because people are anticipating rates coming down. So they're in. Plus, I've already told you everything else that's happened. You got these mega companies killing it. It's a lot going on. That's unusual, right? Lot going on. But I've done well. First 6 months, right? S&P 500 ETF, SPLG, 15%. FTEC, Information Technology ETF, 25%. MAG 7, about 35%. You already know what NVIDIA has done, over 150% for the first 6 months. So, hey, and then obviously, good old Tesla. Good old Tesla. Good old money-making Tesla. Money-making Tesla. Love Tesla. Just keep making money on Tesla, right? So that's the plan. The plan is to keep up with this information, use this information to my advantage, use this information to be a better investor. That's the reason I have these calls, guys, so that y'all can also use this information to become better investors, right? You should use this information to become a better investor. Don't abandon your plan. Like I told you, if you're concerned about one of the stocks in your portfolio, what you need to sit down with yourself and do a little research and figure out, why is the stock not performing well? Especially in an environment where the overall stock market is performing well. See, my rule of thumb is this. I want all of my investments to outpace the broader stock market. I want all of my investments to outpace the broader stock market. What is the broader stock market to me? The S&P 500. That's the broader stock market. So if the S&P 500 returned 15% in the first 6 months, all the rest of my investments need to outperform that, because the S&P 500 is my steady Eddie. So my FTEC, Information Technology ETF, it has to outpace the broader stock market, right? NVIDIA has to outpace the broader stock market. The Magnificent Seven have to outpace the broader stock market. Tesla has to outpace the broader stock market. That's my measuring stick. If I got investments over here that are not performing above the S&P, what do I need y'all for? I could just put my money in the S&P. I don't need y'all over here. If you can't outperform the S&P, I'll just dump all my money in the S&P in that situation. Why would I have something over here giving me a 5, 6, 7, 8% return when the S&P is doing 15? It don't make no sense. So look at your portfolios. Look at these stocks y'all have purchased. Look at these other ETFs that you've purchased. If they're not outperforming the broader stock market, the S&P, you have to ask yourself, why? You do. Because I get the question all the time, well, Richard, I got this, I got that. What do you think? Is it outperforming the S&P 500? No. Well, I'm not sure why it wouldn't. I mean, this is the broader stock market with all the 11 industries. If you're over here in an industry that's 3, 4, 5, 7% return, why would you be in that stock? Why would you be in that ETF when you can be over here in something getting 50% on the broader stock market? Don't make any sense to me. That's why I say, for the majority of us, the only thing you got to buy is an S&P 500 ETF. For the majority of us, you don't even need to deal with anything else, most of us. So if you're looking at the portfolio and you're trying to say, well, what should I keep? What should I get rid of? Start with the broader stock market and then use that as your measuring stick. Okay, I got a 15 over here. I'm in the building stage of wealth. I'm not in the enjoyment stage of wealth where I'm trying to protect wealth. I'm trying to actually build wealth. I ain't got enough wealth. So I got to take a little more risk, and I got to get something comparable or better than the S&P. If I'm in the building stage of wealth, right, I'm trying to grow wealth. I'm not trying to preserve wealth that I don't have no wealth yet. I'm trying to grow it. Now, once I grow it, sure, I can take it out of the stock market and go protect it somewhere where I'm getting something way less than a 15%. That's okay, because I've already built my wealth. Now I'm trying to protect it. But if you're in the building stage of wealth, man, and you ain't outperforming the S&P with whatever you got in your portfolio, you got to take a second look at that, guys. You're missing something. You're missing something. There's no way your investments shouldn't be outperforming the broader stock market. Shouldn't. because that's considered average. I want something that grows faster than the market. I want something that gives a bigger return, better return than the market. So if I'm in things over here that don't give me that, why? You gotta ask yourself why. You gotta ask yourself why, especially if you're trying to build wealth. The goal is build wealth. And how do I build wealth? I gotta attach myself to fast-growing companies, fast-growing ETFs that outpace the market. Right? If I'm getting a 15% in the S&P, anything else I invest in outside of the S&P has to do better than the S&P. If it's not, I just put all the money in the S&P. It don't make no sense for me to get a 7 or 8% return when I can get a 15% return in the S&P and be in every industry, every sector. I mean, would you agree with that or no? Maybe I'm missing something here. But why would I take a 5, 6, 7, 8%, 10% return when I can be in a 15? And I'm in the building stage of wealth. The more compounding I get, the faster I get to wealth. So if I'm at a 7% compound and I can get a 15, I get to wealth twice as fast than if I'm in 7, if I can go to 15, right? If I can go to 20, 25, 35, 150, I just shorten the gap. I get there quicker, faster, right? So, well, appreciate y'all, man. I'm gonna get on out of here. It's getting late. I know it's 9 o'clock and I said y'all was gonna keep y'all just an hour and that's all I wanted to do. So hopefully this conversation around the Fed was helpful for some of y'all to give you an update on what's going on with interest rates. What is the Fed thinking? The 19 members that are on the FOMC, what are they thinking? I think we just went through that. It's a little divided right now, right? We got some people, let's keep them where they're at. We got some people saying, hey, we got to watch the economy. We got to be ready to reduce. We got some people saying, oh, no, pump the brakes, pump the brakes. Let's keep watching this thing. We may even need to increase. So they're all over the board right now, all over the board. We got to continue looking at our investments. We got to continue measuring them against the broader stock market, which is the S&P. If they're not going to outperform the S&P, for me personally, not you, but for me, I don't need them. I can just put my money in the S&P. If you can't outperform the S&P individual stock, I don't need you. I can just put that money in the S&P. If you're not going to outperform the S&P Mag 7, I don't need you. I just put it in the S&P. So look at rebalancing when you need to, getting rid of positions that are underperforming. Take that money, put it in positions that are overperforming. Don't be afraid to do that. Don't stay in something too long if it's business performance that's driving the stock down. Don't stay in companies that are going backwards, guys. They're not going to save themselves. You're not going to save them praying for them every night. Get out of them and put your money in the winner. Nothing wrong with that, right? Again, not your financial advisor, but that's just a little tip. Always be looking at the portfolio and you want to measure it against the broader stock market. You want investments that are not in the S&P to outperform the S&P. And if they're not, do what you will, but if it's me, I get rid of them and I put them in something that can outperform. And if I can't find anything to outperform the S&P, then I put it in the S&P and I just call it a day. So thank y'all, man. Get down to that description box. Click on that Moomoo link if you want that Moomoo offer where they're giving you up to 15 free stocks, guys. All you got to do is click on the Moomoo link, open up your Moomoo account. If you put $100 in there, they're going to give you 5 free stocks. If you put $1,000 in your new Moomoo brokerage account, they're going to give you 15 free stocks. Guys, do not miss that offer. Get down in the description box. Click on that Moomoo link tonight. Go ahead and fund that account so that you can get yourself ready to go for Friday or next week, and you can start buying paper assets to build your wealth. There is no greater time than right now, guys, to position ourselves to build some tremendous wealth. There is no greater time than right now to transfer wealth transfer wealth to us and our family. But we got to be willing to execute. And one of the things you got to be willing to do is get down and open up that Moo brokerage account for you people who are just getting started, or even for you old vets that want to be able to do something different than what you're currently doing in your other brokerage account. You can use the Moo brokerage account to do that. Maybe you want to do fractional share trading. Maybe you just want to have a small position over here in your favorite stocks that has nothing to do with all your retirement funds and everything that's over here. You just want something over here that you can play with, that you can do on your own without worrying about jeopardizing your future over here. You just want something that you can grow on your own. Moo brokerage account would be perfect for you. That way you can keep your primary brokerage account, do all your stuff you got to do, and let that continue doing what it's doing, but develop this position over here where you control it. I love that. I love being able to control my own investments, put it in stocks, put it in ETFs, sell it, do what I want to do. I love that. I love that feeling every time I make a trade and I win, right? There are going to be sometimes I make a trade and I lose, but the goal is win more than you lose, right? That's the goal. So, for everybody, brand new folks, veterans, you can get down in the description box, open up that Moo brokerage account, go get that free stock, guys. Go get that free money, and send me an email for your new people who want to learn how to use it. Maybe even for your vets who may not know, how to use these self-directed brokerage apps. Send me an email through my website, www.richardfain.net. Second link down in the description box. Send me an email and say, hey, Richard, I opened that Moo account. I funded it. Would you send me those tutorial videos so I can learn how to use the app? And then send me your wealth transfer blueprint 1.0, 2.0, where you outline all the investments you're buying. So if I want to copy that plan in my Moo account, I can. I don't have to, but if I want to, I can. I know what you're doing. I'll be more than happy to send you all of that information, guys. All you got to do is send me an email through my website, www.richardfain.net. Second link down in the description box. Well, thank you guys for rocking with me. I appreciate you. I'll be back tomorrow morning, 10:30 a.m. Eastern time. I know we had a late night edition. I so appreciate y'all who stayed up a little bit late to hang out with me. I love doing what I do, and I love just sharing information with you guys. And it's so much information that I like to have multiple live streams so that I can hit topics, different topics, and get you guys all this information so that y'all can have a wonderful 4th. I'm gonna be working on 4th. I'm gonna be on this YouTube channel twice tomorrow, working on the 4th, even though I hope all of y'all have a wonderful 4th that's celebrated. But be ready to go back to work on Friday, building that wealth. When that market opens up on Friday, it's gonna be a lot going on. You're gonna have that jobs report that's gonna hit at 8:30 a.m. Eastern time, I believe, in the morning. It's gonna, if it's a good report, to the moon we go. If it's not good, we may have a slight sell-off, so be prepared for that. There may be some opportunities to pick up some bargains. There may be some dip opportunities on Friday. If the labor report, the jobs report goes against us, we may see a little bit of a slide in the stock market. You may be able to pick up some discounts on Friday. So have your money in your accounts ready to go just in case it's a red day and we can pick up some discounts. Well, thank y'all, man. Appreciate you. Lock it in with a thumbs up before you get out of here. Thoughts become things. See it in your mind. Hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. Stay healthy, get wealthy, and I'm going to catch you guys on the next one. Peace.